Hey everybody, good to be here today. My name is Brent Moores, and it's our weekly look at managing an options portfolio. Glad you joined me, whether it's live or on a recording. And today we're going to look at a variety of different options positions and talk about managing them. And so we'll get to that in just a minute. But let me just mention, alongside me is Ben Watson, helping me out in the chat. Ben's a over 20-year colleague of mine now, and I've learned a lot from Ben over the years. Make sure you check out some of his webcasts. And if you're, he's kind of the face of our Schwab live events here. So make sure you check out some of those live events. If there's a workshop in your area, check it out. I think you'll benefit significantly from those. And yeah, you can follow us on X as well, at Brent Moores CS, at Ben Watson CS, for additional content throughout the week. Before we get too far into this, let me just mention a few important disclosures here. Options do carry a high level of risk and are not suitable for all investors. And multiple leg option strategies will involve multiple transaction costs. Short options can be signed at any time up to expiration, regardless of the in-the-money amount. And the paper money software application is provided for educational purposes only. It allows you to engage in simulated trading. It's a great learning tool, but it's certainly no guarantee of future success. And one of the differences between the paper money account and the real account is that the paper money virtual trading application will not assign short options early. That's different than a real account. Probability analysis results are theoretical in nature. Past performance is no guarantee of future results. So, just think about those. One last thing, Schwab does not recommend the use of technical analysis as the sole means of investment research. Let's head on over and look at the markets. That's the S&P 500. We're off a little bit today, but the trend is hanging in there strong above that 20-day moving average. Will the high there that we hit present some resistance? Maybe, but you know what? For a trend trader, you could look back historically and look and say, oh, we had a high here. Are we going to be able to break through it? We had a high here. Are we going to be able to break through it? And go on in history. And you know what? Each time we've broken through the previous high. So for the trend trader, a previous high is not necessarily a strong resistance point on that. You never know. At some point the trend will end. But for a lot of trend traders, that time has not come. The trend has not ended here at this point. And I'm glad Ben put a calendar of those live events in the schedule for those of you watching live. You can also go to schwab.com/coaching, and there's some different choices on that screen, including our live events. Let's look at a trade here. I want to just look at an example trade. Of course, we have earnings season. We're at the beginning, more or less, of earnings season still. So most of the companies we're looking at still have earnings coming out. I'm deliberately kind of looking at trades here right now to avoid some earnings. Of course, we had Netflix last night. We had Walmart a while ago. And so I double checked. Walmart next earnings when's next earnings? The 20th. So about a month away. So if we were going to do, say, a vertical spread, I'm going to talk about a short vertical here. Consider not just where earnings are compared to your expiration, but consider where earnings are compared to when you're planning on exiting a trade. So even if I pick an expiration date that's beyond earnings, ask yourself if you're going to get out of it before that. And so when we talk about managing trades, it's key to know not just what your theoretical max loss and max gain are, but what your gains and losses you're looking at taking. Let me give you an example on that. For this trade here, I'm going to just start off with a sample trade and then we'll look at the specifics. For this trade here, what I'm assuming is we jumped up, we've kind of established potentially maybe a bit more of a new support level here with an upward trend. So I'm going to take a bullish posture on Walmart here for our example trade. Now, obviously, if you're bearish on this, you wouldn't do this sample trade that I'm going to show you. But I want to just kind of give you an example on that. Let's go to the trade tab. I'm going to go out about a month here. Now, this is actually, I think we said earnings was November 20th. So this is actually a day beyond earnings. But if we're doing a short put vertical, normally we're looking to exit before earnings anyway. And there's a good reason why, and I'm going to show you that reason why in just one sec. Let me go, I'm going to sell this 105 strike. Okay. I'm going to look to buy the 104 strike. So there's my short put vertical right now. Now, if I analyze this trade, let's go to this risk profile tab here. Okay. Here's what we got. Actually, we'll get to the dollar. We'll get a little bit of a better view on this. Let me just double check one thing. We said this is a November 21st expiration. Okay, that works out. And today is the 22nd. One sec. Is today the 22nd? Today is the 22nd. Let me just make this on the 22nd here. So this is what the trade looks like right now. But what I want to show you is this. If we are talking about this trade here, and I'm looking at this, what's my reward to risk ratio on the trade? Now I can look right here on this. Let me actually do this. Let me just confirm and send. I'm not going to send it right now. 34 max profit, 66 max loss. Herein lies the problem with short verticals if we do them out of the money. And I'm setting up, this is a pretty typical setup I'm using here on this, okay? So 34 max gain, 66 max loss. Do you see the problem? If we let this go to a max loss, we've doubled our max loss. We can win a lot more than we lose and still be in a bad situation on this, okay? And I can even shift it. It can even look worse. Let me do a 104, 103. Let me click on confirm and send. Max profit 29, max loss 71. How do I figure out my return on risk? I can just divide 29 by 71. I come up with about 40% return on risk there. Okay. So actually, let me do that. I want to analyze this one. Let me analyze this trade. Pull this up. I'm going to get rid of that other one there. And you can visually see this on this graph, by the way. If you look at, here's our break even. This is just a profit loss graph. For those of you who aren't familiar with this, this represents our potential profits or losses. And here's our break even, 0. This represents the underlying stock price here on this, okay? Now, where's the current stock right now? Let me just unfloat this. Here's where we are right now. So if we go to expiration on this trade, we're in a winning position, which is great. But look at the difference between where our break even is and our max loss, and compare that to where our break even is and our max gain. Do you see the difference? A much larger potential max loss than max gain. So this is why we want to avoid max losses in this scenario. How are we going to avoid max losses in this scenario? Well, we may put in a exit if we break a support level in the case of a short put vertical, or an exit if we break a resistance level in the case of a short call vertical. But what I also want to point something out to you. Here's the purple line. That represents today, because that's what I have right down here. This blue line, what we were looking at here, represents at expiration. Notice there's a big difference between those two. And what happens is if I go to expiration, and in fact, let me go to a week before expiration. Let me go to November 14th was a week before expiration on this. And let's say we look at this shot now, look at this trade now, a week before expiration. This purple line represents, it's theoretical. We don't know exactly what it's going to, what it's going to look like. The scenario is between now and then. Prices can change, implied volatilities can change, but let's just kind of assume this is correct. This is probably not, you just never know, but this is the most accurate representation estimate that we have right now. Okay. But look, let's say the stock does go down. It's at 107 right now. Let's say it goes down to 102. Notice a week before expiration, we're nowhere near, if this is correct, a max loss on this trade. And hence we have a rule that we're going to use in this webcast, and a lot of traders use something akin to this, maybe not exactly this, but normally we're going to say if we're under, say, 10 days to go to expiration or about a week to go to expiration, we're just going to exit this trade. Why do we do that? Well, the reason is because we're going to avoid the max loss. And not only are we going to avoid that max loss, it can be a pretty significant difference there in this. In other words, sticking with the 102 level, we'd be losing about 33, 34 bucks here at that point. Well, remember, our max loss here is about 72. So we're cutting that loss potentially in half or less than that. That's why we get out. That's why when you're managing short verticals, and I'm using a short put vertical as an example, but you can do the same thing holds for short call verticals, by the way. That's why we get out ahead of time. Now, it's not all good, because if we get out a week ahead of time, and we'll just say the stock stays where it's at, I'm not going to be making my max gain either, okay? I'm cutting out my max gain here also. Now, if we're bullish on this, if the stock goes up a little bit, we're getting closer and closer to that max gain. So that's the rationale on this. Remember, with any option trade, I want you to think about ahead of time 3 things in terms of exiting. Where are you going to get out if it goes well? Okay, what if it goes well? Typically on these short verticals, short call verticals, or short put verticals, the rule we've used in this webcast is if you get to about an 80% gain, we're just going to exit out. We've made 80% of what we can make. That's great. We're going to take that. What if it goes bad on us? What if it goes poorly on us? Okay. Well, if it goes badly on us, then we're going to exit. Usually we're just going to say broken support or resistance. Okay. Broken support or resistance. And what if it's just going, we'll say, so-so, or it hasn't broken support or resistance, and it hasn't hit the 80% gain. So if it's going so-so, we're going to say about a week to go to expiration. Okay. We're going to look to get out of those trades. So let's look at this. Let's add this trade in. Let me see if I can answer any questions here. And then we'll put this trade in, and then we'll look to managing some short verticals and other types of trades as well in that portfolio. Okay. So let's see, Ben, you answered that question. Thank you. Appreciate that. Brent, I've been looking at how volatility is affecting the equilibrium point on the trade. Can you break it down for me and share what strategy you recommend in a market like this? Okay. So when we're doing short verticals, these are Vega negative trades. However, they tend to be remember, there's a long strike and a short strike, okay? A long strike and a short strike. And to a large extent, not entirely, they offset each other. So it's not nearly as significant an impact as if it were just a single, say, short put we did instead of short put vertical, or short call we did. How's implied volatility going to affect things? Now, we can talk about implied volatility on the market as a whole if we want. Okay, we can look at that VIX. Can that impact the trades you do? Yeah, it certainly can, but keep in mind, we can look at the VIX, which is the market as a whole, but also consider the individual stock you're looking at. And that may very well look different than the VIX. Right now, implied volatilities are, I'd say, relatively high. We're at about 18, 19 on the VIX. On average, we're a lot lower than that. Now, we spiked. We're coming down off a much higher level. And ideally, if we're doing these trades, implied volatility is high and going down. When you're thinking about this, and we're looking at a trade like Walmart, what's implied volatility likely to do? Well, it may go up higher. It's already increased a fair amount. Last time we had earnings, it was about this level here, okay? So we're at about the same level as it was before our last earnings. Now, it may go up higher. It was up higher prior earnings, but this was in the midst of a very jittery market back in April. You can check the April charts, and it was very high. So expectation is, you got to say, what do you think volatility is going to do? And I would expect volatility to drop after earnings significantly, but we're not holding it till after earnings. Do I expect it to go up a lot more? Well, that's a question you got to ask yourself. In this case, I'm not expecting major changes in implied volatility, so it's likely not going to affect the trade that much. But when you're doing these short verticals, which is what kind of I'm starting on, short call vertical, short put vertical, ideally you're looking at a market where you expect implied volatilities to go down. Now, what's going to impact implied volatilities over? Well, news well. How does earnings season go? What's the progress on the government shutdown? What's the progress on trade and stuff like that? What's CPI going to come out on Friday? How's that's going to affect things? Those can certainly things move up or down. But if your assumption is implied volatilities are going to go a little bit more towards a mean level, it would benefit these short option strategies. Okay. Now let's go ahead and place that trade. I'm going to put this trade in. I'm going to do more than one contract. My max loss, and remember, we're hopefully not going to take that max loss, is $71. So I'm going to actually do 4 contracts on this, and I'm just going to confirm and send. There's my mid price. Likely we won't get the full mid price there, but I'm going to move it down just a little bit off that. We'll put this in our short verticals bucket. Now, regardless of how we end up with a short vertical, whether it is a iron condor or just a short vertical itself, let's talk about some of these. So for example, in the case of Cisco, first thing I always check, are we under that 10-day mark? We already talked about why that is key. We're not under the 10-day mark. Secondly, when we're dealing with iron condors, I'm going to deal with them as separate trades. One way, without even looking at the price and the price we got it, or profit loss opens and profit loss closes on these things, before you look at those things, one thing you can always consider is, where's the stock and where are the strikes? The stock's at $70. I have a 65.66 put, so that sounds not bad. I have a 72.73 call. That's getting a little bit closer, but doesn't sound terrible. So that's one way to look at it, just to start out. We can look at the chart, of course, But another thing we can do is if you have a PL percentage column on here, you can kind of look at them. Now you got to kind of do, remember, we're looking at them, like I can look at overall the number, but that's not really what I'm getting at. I want to look at these separately. This is basically kind of, canceling each other out on our puts there. It's not significant. Now, look at our profit loss. We're overall doing okay on the puts. Not surprising given that we saw on the strike price. Calls, well, we're losing a little money here. Not a disastrous amount of money, but we're losing a little bit amount of money. So without even figuring out the exact how much we bought it for, have we made 80%? Then we can just kind of look at these numbers and get a pretty good sense of that on that, okay? So that's kind of how I would consider that. So my instinct here right now is, hey, puts are doing good. We haven't made 80% of what we can make on this thing yet. But look, how much should we trade this for initially? That's 25 cents is what our initial transaction was on the put side of things. Right now, it's about 9 cents here, okay? So doing well, but we're not going to get out of that put side. Call side, things aren't doing great. They're actually losing a little money, but have we broken down technically on it? Cisco, are we just super bullish or are we more neutral at this point? Let's look at Cisco, okay? So let's look at the chart. Cisco, super bullish, I mean, we were kind of looking neutral. It's kind of flirting with some more bullishness. What if we say this? What if we go and say, if the stock breaks significantly above this level, I just want to get out. So I'm going to say 71.5. Maybe we exit. 71.5. So can I put that trade on to exit at 71.5? I'm going to highlight those two levels, okay? I'm going to right click on this. I'm going to create a closing order for my call side. Here's my closing order for my call side. And I'm just going to make this a market order, good till canceled. I'm going to click on the gear and I'm going to say, if Cisco marks greater than or equal to 71.5. Okay. I'll answer a question in the chat that's going to be easier for me, I think, to answer than Ben, to be honest. So let me put this in here. And so that's just an exit order on that side. Other than that, we're going to let it sit. Now, observation. I clicked on the 7. What's the 7? I just have my charts linked, right? You probably have your charts linked, right? You got a watch list. You got a chart. I have both 7 orange. You can do green 3. I don't even remember if that green's 3 or not, but it doesn't matter. If they're the same thing, when you click on one, it brings up the other. Well, in this case, I just have it linked right here, okay? So it just allows me to click on Cisco here so I don't have to type in the symbol. Okay, let's move on. Let's look at some others. Datadog. What do we have here? I've got a short put vertical. Remember our 3 parameters here. Less than 10 days to expiration. Nope, we got 30 days to expiration. Have I made 80% on this thing? No, I haven't made 80%. Looks like I'm up about 23% on this trade right now. Is it in serious danger? Well, overall, I'm making money on this trade. Now, I can verify this and look at the chart if I want to, and if I had more time, I probably would. But you can just verify that it still looks kind of bullish. But I want to move on here. So let's keep on looking. Now, here is one that is not looking so hot. This is one that seems to be having some problems. This is a short put vertical on JP Morgan. Stock price, 292. Strike prices, 300, 295. That is not good. Still got a lot of time, but this is one where I'm going to say, am I bullish on this? Let's do it. Let's take a look. You know what? This was my support level. Okay? That's my support level. Things are not looking good. I'm more bearish on this than anything. I'm just going to cut my losses. I hate to do it. It can be painful, but I'd rather take the $155 loss than, how much could this loss potentially be? Well, it could cost us $500 to buy back. Now, that ignores the initial credit that we brought in of about $135 there I brought in, but it can certainly get a lot worse than where we're at right now. So I'm going to cut those losses short. One thing to consider is this. This is a short put vertical. Very often we talk about, one of the great things about short put verticals is they're theta positive trades. Well, look at your theta here. Is your theta positive? Or to sum it right there. No, our theta is negative, because if these are out of the money, they're theta positive. If they go in the money, which these have, they turn into, time decay is working against us. The current situation is working against us at this point. We're just going to bail on this one. Time to cut bait on this and get out of this trade. So I'm going to right click on this. I'm going to create this closing order, and I'm going to look to get out of this. Confirm and send. So we'll take our lumps on that one and just get out. Now, good question from Mari, if I'm saying that, or Mary Burns, probably. Mary in the chat. What about reversing the polarity? This is a great question. And that's one reason I want to bring it up to everybody. We were looking at JP Morgan. Our initial trade, I don't even remember when we got in this thing, but our initial trade was, hey, I think we were looking at a bounce here maybe off this when we got in. Well, the bounce fizzled, right? And it just went down on us. So the question is, instead of that short put vertical we did, what if we change this into just a long put or a short call vertical? Like, to go to a short put vertical, when we did a short put vertical, we sold a put and we bought a put. We did a long put. What if we just closed out of the short put on that and just left the long put? At that point, then we'd be switching it from a bullish trade to a bearish trade. So my answer to that is this, and this is universal. It's not on this stock. When you're considering rolling a trade or changing a trade, ask yourself this question. Forget the history. Forget the fact that this trade didn't work out well. If you had fresh eyes on this, is this a trade that you would do say a long put on? If it doesn't matter what the history is. If you would enter a long put on this trade right now, given what you see on this, then the answer would be absolutely, you can reverse the polarity on it. The challenge is, too often, I've felt it myself, I've seen it in other people, too often it becomes kind of this revenge trade of, well, I messed up on the initial one, I want to get my money back on this trade. Therefore, I'm going to reverse that polarity on that. I'm going to change it from bullish to bearish, and because I want to salvage this. Nope, sometimes you got to cut losses. Now, if this is a new trade and you can disassociate yourself from the past on that trade, it probably makes sense on that, okay? Good question, though. Very good question. Appreciate that. NVIDIA is a trade. Now, this one's a little bit different. This one's a little bit different. Now you look at it and you go, well, that's an iron condor, right? It is an iron condor, but here's what I want you to notice on this. look at the strikes. I've got a 160, 170 put. It's a $10 difference, by the way. And I've got a 205, 210 call. And that's a $5 difference. In other words, I've skewed this thing. I've unbalanced it. If you're interested in learning more about those trades, I talked about this very subject this past Friday. Today's the 22nd, so this would have been, I don't know, about maybe the 18th. My math's probably off on that. Well, actually, you know what I can do? I can just click on this and see when we entered the trade. 17th. I talked about on the 17th in our condors, calendars, and butterflies spread class. And it was about skewing iron condors. What does this do? What's the effect of this trade? Well, the effect of this trade is we've actually kind of made it more directional. In other words, if I go to NVIDIA on the Analyze tab, here's NVIDIA. Let me just shrink this down so you can see it a little better. Okay. Didn't mean to shrink it that much. Here's the current price. There's more risk to the downside, more upward potential. We've made it more of a bullish trade. It doesn't affect, okay? It doesn't affect how you're managing it though. We still have a short put vertical and a short call vertical. In terms of the put vertical, we're losing some money. You can see this. Hold on. Here's my PL open column. By the way, if you want to just kind of affix those column headers, you can always click on that little anchor there. And then when I scroll up, it keeps that there. But you can see I'm losing some money on the put side of things. So we're going to look at that a little bit further. The call side's doing pretty well. Okay? The call side is doing pretty well. And so when it's going pretty well, of course, we have more than a week to go, more than 10 days till expiration. So we're going to let this sit. Have we made 80% of what we can make on this? No, we haven't made 80% of what we can make on this. We entered this trade for about 65 cents. It's still roughly 30 cents or so, a little less, 25 or so cents on this. So call, we're just going to let sit. Put, has it gone completely south on us? Well, it's gone a little south on us. Stock 178, strike, we're still above it. So have we turned just completely bearish on this trade? Well, no, I wouldn't say this. I'd say it's still doing okay, may go down a little bit more, but if we start to break through a support level, then we'd look to exit that. So I'm just going to let that sit. Now, I don't want to spend the whole time just on short verticals. I want to look at some other things here. But so let me just kind of quickly go through some others. We did another unbalanced in a slightly different way than we did on the NVIDIA trade. You're still going to manage it the same way, though. This one I unbalanced by adding different quantities of contracts here on those. Still an iron condor, but I have more, I have some additional puts there on that. Another way to think of it is it's an iron condor plus I have some extra put contracts. You can tell from our PL opens, we're actually making money on both sides of those. We've not made 80% on either one, so we're going to let that sit. Okay. All right. So I think that's what I wanted to do that's all I wanted to do on short verticals and iron condors here. Now, something else. Let me just mention this. Our short puts. I only have 2 days to go to expiration on this. If I've gone in with the idea of, which very often we do on just plain short puts, if we go in with the idea that I'm happy to buy the stock if it goes in the money or if it gets assigned, And it doesn't necessarily have to go in the money to get assigned. Technically, it can be assigned early. But if I'm happy buying that stock, then I'm not going to get out a week to go to expiration. I'm just going to let this sit and run. Right now, the stock is above this, so barring a pretty decent change in Apple, it could. I mean, $7, $8 isn't a massive move in Apple, but I'm happy to buy it anyway. Just going to let that run to expiration. Now, could I roll it? I could roll it. Let's take a look at Apple here. How about, okay? Let's just take a look at Apple. Our strike was 250. So our strike is down here right now. There's a pretty good chance that it's not going to be below that. So at that point, there's a high likelihood this is just going to expire. We've taken our money. One thing we could do is we could look to roll it and sell another put. If I really want to buy it, I can. We have earnings coming up. Maybe we want to wait until earnings is passed before we do anything on this. So in this case, that's what I'm going to do. I'm going to say, I'm going to avoid earnings. Now, just a thought. You don't always have to avoid earnings at all costs. What's Apple going to do on earnings? I don't know. It may go up, it may go down. It's likely to make a significant move on earnings because it tends to move a lot on earnings. Stocks tend to move quite a bit on earnings. No guarantee. It may stay just plain there. So, but it's as likely, to go up as it is to go down or down to go up. You could take the stance that, hey, in fact, Sia in the chat said, hey, the trend is bullish. Yeah, I'd say that's a generally bullish trend. Now, trends sometimes change with earnings. One thing to take into account, though, is this, and it doesn't mean you can't do a short put. There's kind of an asymmetrical risk with short puts. What's the most I can make on a short put? The premium. That's the most I can make. So if I sell something and say I get a $5 premium or something on it, $5 or $500 is the most I can make. What's the most I can lose on a short put? Well, a lot, right? If I sold a 250 put, I could lose $25,000 on that. So when I say there's an asymmetry in the reward and risk on that, that's something. It doesn't mean you can't do the trade. It just means something to take into account when you do that. That's different than buying the stock. If I just bought Apple stock, Apple can go up and up and up and make a lot of money. It can go down and down and down. I can lose a lot of money. Just basically the same risk as the short put, but my potential gains are much less than that. So just something to come out. Sia said the iPhone sales came in, and the iPhone 17 sales have been pretty good for Apple so far. Okay, and so that's been good. Down a little bit today. I guess they're having some challenges with their foldable iPad or something like that. That's not helping them a lot, but there you go. Let's look at some other types of trades here. So I'm just going to let Apple go to expiry. I think there was another just short put. Same thing here on AT&T. We're willing to let this go to expiration here, or we'll at least evaluate it next week. All right. Now, I'm running a little low on time. Let me just look at, let's look at Nike here. Okay, let's go down here. Here's Nike. This is we've looked at this each week pretty much. This is kind of our poor man's covered call, so to speak. It's a diagonal spread. We've lost a lot of money on the long. We've been rolling the short. The premiums we've brought in on the rolls on the short have not made up for we're still at a net loss, although it's less than what this would indicate right here. We could roll this again right now. We got 16 days to go. How much do we have left? There's still $44 left in this contract. It's a nice positive theta trade. So each day, everything else being equal, this is going to benefit us. The time decay is going to benefit us on this. So in another week, we'll reevaluate it and consider rolling it again. But right now, our goal is just to keep on rolling this guy. And just remember, when you do roll, there are multiple transaction costs involved. But our goal is to keep on rolling this, chipping away on this. Now, the performance of Nike has been not good. It's been going down. But you know what? We've minimized the losses by being able to roll and roll and roll this. And so we're going to continue to try and do that and see how that works. Okay. I think I'm going to call it there because I want to just mention a couple things before we go here. And I'm just going to pull this up, and I'm going to pull up YouTube here real quick because I just want to mention if you're new with us, let's say you're new with us and you want to find our content here, you can just search sorry, I can't type very well. I have a bad finger right now. Trader Talks Schwab. If you just search that, you'll see different results that come up, and you'll see, hey, Trader Talks Schwab. Click on that. And then what you can do is you can subscribe to the webcast there. And you'll see a whole bunch of different things, including different playlists. You can see different playlists from different webcasts. And so this is the class I referred to just a minute ago, but you'll see others, including Ben Watson teaches trading futures on Tuesdays. You want to learn about futures? I can't talk about futures in this webcast. Well, if you want to learn about futures, check it out on Tuesdays. Okay? All right. Thank you, everybody, for joining me. Thanks for your questions. And this week, we talked about kind of the reasons why. We talked about max losses versus and how they're affected if we get out early. How usually, I can't guarantee you're not going to take a max loss if you get out early, but it really minimizes that on those short verticals. We also looked at a variety of other trades. Appreciate you joining me. And stay tuned, or coming up next, we've got trading price patterns. Make sure you check that out, and we'll see you all same time next week. Bye-bye, everybody.